So let's look now at whether mortgage interest rates can fall even further from their existing low levels. I think they can. I think they can fall another 25 to 35 basis points. But before we do that, let's just recap what we've looked at already. We looked at how much mortgage rates have fallen since the middle of 2019, and especially the tumble that they've taken since the beginning of the COVID-19 crisis. And to understand that fall, we took the mortgage rate that banks charge their clients and broke it into the two main parts. The cost of funding, which is the interest rate that's paid to depositors or paid to corporate bondholders, the cost of raising the funds to lend out as mortgages, and then on top of that, the net interest margin that banks earn between what they pay to get the funds and what they charge to lend the funds out. Now, we started off with the funding cost here and decomposing this funding cost into its parts to understand why the fall in funding costs has driven down mortgage rates. And we did that for fixed rate mortgages, and then we did that for floating rate mortgages. And in both of those, we saw that these funding costs have come down so much that we can't really expect them to fall anymore. Unless interest rates go negative, which is not impossible, we shouldn't expect mortgage interest rates to be driven down by a further fall in funding costs. So what could drive down mortgage rates? Well, this margin could compress. And to understand that, let's look at what composes this margin. There's these three parts. There's the cost of origination and administration, which means the fees that are paid to mortgage brokers or the costs of running bank branches to find customers and to do the paperwork. Then there's provision for loan losses. That's the losses suffered if a loan isn't paid off. We shouldn't expect either of these things to fall. But we might expect that this pre-tax profit margin of banks will come under pressure as banks compete more severely. Now, why should we expect banks to enter into more competition in making mortgages, even hyper competition, as they try to grab market share off each other? Well, for two reasons. One is because they've got access to a lot of very low cost funding which they need to use or lose. So they've got a deadline of the 1st of June 2021 to use the extra $105 billion of essentially zero cost funding that's been provided to banks through the Term Funding Facility. So the Term Funding Facility, as we've discussed already, provides banks with 3-year money at 0.1% per year. As I said, very close to zero. Now they've got to use that before the 1st of June next year. That puts pressure on them to grab market share to use that money up. But there's a second, a very important thing, which is the fall in the return on shareholder equity that banks have experienced since the GFC. You can see the return on shareholder equity used to be up around 20%. It's fallen, and it's really tumbled in the COVID-19 crisis down to around 7%. And that puts a lot of pressure on the management of banks to grab market share to drive their return on equity up. Now, what's causing this to tumble is that banks have so much extra shareholder equity now. And we can see that since the March of 2013, the total bank capital in Australia has risen by $95 billion. It went up a lot after the Financial Systems Inquiry recommendations, and then it's gone up a lot in COVID-19 because banks have been forced to retain earnings inside the bank. The banking regulator, APRA, hasn't allowed the banks to pay out more than 50% of their earnings as dividends, and that's caused the retained earnings to swell the capital of banks. So banks are under a lot of pressure to put that capital to better work by grabbing market share from each other. So they've got the Term Funding Facility that they need to use by the 1st of June. They're under a lot of pressure to grab market share to improve their return on equity. Both of those things put pressure on banks to compete with each other a lot, and we should expect that competition between banks to drive margins down and therefore to drive mortgage rates down.